G'day everyone, welcome to this weekend general update on the market. And there's not a lot has changed in the last week. The rally in the US continues on. It's really quite amazing in one sense, but not so amazing in another, because the fundamentals that are underpinning this rally in America really are pretty solid, and there's no reason why it can't continue for some time. There'll be dips along the way, of course, but I would expect that they'll be relatively mild. So not a lot has changed since last week, but let's have a look at what actually did happen last week. The S&P managed to rise 6 points on the week, formed another all-time high, closed above 1,800 points for the first time on record, so that's significant. There was a 3-day mild dip in the middle, and then the index was off again. The Russell 2000 also at new all-time highs as well. So this is across the board in America. It's not just about the major stocks, it's right across the board, small and mid caps as well. So extremely positive. Now, I posed this question last week. It's worth restating again for anyone that perhaps didn't see last week's. The S&P, I believe, can still keep rising several hundred points over the next year or so. The reason that I say that is that the average price earnings ratios always tend to rise in a low interest rate environment, because people want to come into stocks because they're getting such a poor return in fixed interest investments. So therefore, more people come in, they push the price earnings multiples up. So that process is still happening. The current level of average PE in America for the S&P 500 is still slightly below the long-term average for bull markets. That average for bull markets is 17.5, and the level is still slightly below that. So please do not listen to the people that want to tell you that the US market is overstretched or overvalued, because they're basing that opinion, I think, purely on the fact that the market has gone up, and that's not the right yardstick. The yardstick is to look at the long-term history, and the reality is that the American market is not expensive. And if you look at some of the biggest companies in the world, like Microsoft and Apple, that are trading on slightly less than 10 PE, it just gives you a sense that the US market is not overvalued at all. Now, low interest rates are virtually guaranteed until 2016 under the new Fed chairman, Janet Yellen, and it could possibly go much, much longer. So this process of the PE ratio multiples still expanding in a low interest rate environment does not need to come to an end. And I've had all sorts of people tell me, quote all sorts of figures about, market rallies never go beyond so many months, and this statistic and that statistic. But what you've got to remember is we've never been in this sort of environment before, where interest rates are so incredibly low and are virtually guaranteed to remain that for the foreseeable future. So some of the old relationships don't necessarily apply to the situation that we're in at the moment. So when you combine the growth in earnings per share, and Wall Street has been pretty conservative since the GFC in their estimates. Generally, companies have beaten, and the market has beaten Wall Street estimates consistently. So if you multiply the current Wall Street estimates for average earnings per share for the S&P 500, and you multiply it by just the normal price earnings multiple that you would get in a bull market, then you can see that the S&P can rise to beyond 2,000 points without any problem at all over the next 12 months or so. So let's have a look at the S&P. So not a lot of change from the previous week. We've still got this amazing uptrend. We've had a break out of this wedge. It came back. It was only a minor break, but it came back and retested and then took off again, as you can see in the last couple of days. So new all-time high. Things still looking extremely positive with the S&P. Just while I'm here, let's have a look at the ASX 200. By comparison, it's lagging. We are miles below our 2007 highs, whereas, let me just pan back and show you that. No, the chart's not going to go back far enough. But we're way below the 6,900 highs in 2007, and our market really was under some pressure last week, and the banks, which had been run up fairly hard, came back a bit, and the resource majors really not making too much progress at the moment. So it's hard work for our market at the moment. So we ended up being down 65 points on the week. There's a bit of a timing issue involved in that because our market index should rise on Monday, although it hasn't been very good in following so far in the last couple of weeks. Now, moving away from the top 10 or so stocks that really make up the index, there's very, very much low liquidity and thin market depth affecting a huge part of our market at the moment. It's just not going anywhere. There's not enough buying, and it's almost like everyone is just playing some sort of waiting game until we get a bit of a correction. So it's very dangerous to try and make something happen in this sort of market environment. You've just really got to wait it out. Now, gold fell by $57 on the week, copped another hiding again. The forces that are pushing gold down really are very strong, and I get the feeling that this process is not complete yet. And the gold stock indices also fell further, so there's no turn evident there yet either. We'll have a look at the gold chart in just a minute. Copper edged back up a little bit to $3.20. I follow copper quite closely because it's a good barometer of the global economy, and copper at $3.20 is indicating that things are okay. Oil was steady at 95, no real change there either. And there's the chart of spot copper. It dipped below this range that it had been in since August of last year, August of this year, but has come back into the bottom end of that range just in the last couple of days. So let's have a look at the gold index. So we've had a downtrending channel. We managed to move above that channel, but then immediately have dropped back into a decline again. So it's possible we're heading back down to 1200 and maybe even a little bit below. The gold index is way oversold again. You can see the last time it was down at this level was June of this year, and that was when we got a rally from 1300 to about 1420. So more than $200 rise in the price of gold. We're back down to that level again now. Let's have a look at the GDX index for gold stocks, and we're back down to a double bottom there. So no sign of a turn up yet, no outperformance from the gold stock indices. So just to wrap it up, from a strategy point of view, short-term correction still has to be a high probability event. But in any case, the potential reward from trying to buy this market now, that you might get a little bit more, but the risk on the downside is significantly higher. And when the risk to the downside is higher than the potential reward to the upside, you should just not play. And that's the situation we're in at the moment. So you really should be partially cashed up and just waiting to see how things play out. There's some great companies out there. There's going to be some terrific buying. Pretty much got it identified what companies I want to buy, broadly the price that I want to pay, and it's really just a matter of waiting until those opportunities click in. Now, I'm saying there should be a short-term correction. It's not just because the index has risen. I think that's an irrelevant yardstick. A correction has to be a high probability because human psychology demands it. When there's that much profit on the table in the American index, some people are going to start to take some profit. And once that process starts, then computer programs click in and amplify the selling, and that's when you get the 1, 2, 3 week corrections. So that's what will trigger that. Where it comes from, whether it's 1810, 1820, 1830, we'll just have to wait and see. But the risk to the downside now is well in excess of the risk to the upside in the short term, and so it's a time for just basically waiting and looking to buy the dips. Now, as usual, if anyone would like to talk to me about anything to do with the market, and particularly about what we provide to traders, not only the recommendations but the full coaching, mentoring kind of process that can help traders to improve their results, and we've been getting very good results this year as we've been outlining each month. Then please get in touch with me. There's my email address, and look forward to catching up with you again next weekend. Cheers.